If you're not willing to do the learning work, you can't have financial freedom. You just can't. You have to study money. If you want to be successful with money, you have to study it. And that's why I love what you do. I loved listening to Mary Buffett's podcast on your thing the other day. If people aren't subscribed to your stuff, they really need to subscribe to it. One podcast isn't enough. You've got to keep listening.
Welcome to Financially Free Podcast with your host, Ney Torres. One of the reasons Ney could retire when he was 25 years old is because he was coached by the best. And now, through this podcast, so can you.
Welcome to the show. My name is Fairla and I will be your host today. Today, we do things a little different as I will be interviewing Ney Torres. The recording is done on the 13th of July in 2020, so it's still during the COVID-19 pandemic. Ney grew up in Ecuador and he hated high school, but afterwards he went to university to study music and business. And he kind of found out that music was not going to pay his bills, so he went into real estate and finance. He lived in the US for 5 years and is currently in the Netherlands, Europe. Today we're going to talk about Buffett's 50% guaranteed per year challenge. Ney did the challenge and he made more than 50% within 1 year in the stock market. And today we will talk about his process. During the interview, we'll give the listeners who are starting out and maybe are not so familiar with finance or investing a little bit of context. So I will try to stop Ney from going into too technical in the beginning, and at the end, we will go a little bit more technical.
Thank you for the introduction. I normally do that, but
you're welcome.
Thank you. You surprised me with the idea for the interview and the introduction. Thank you very much.
Thank you.
Yeah.
So tell us, why did you hate high school?
I couldn't read. I had, how do you call that? Sickness where you cannot read very well.
Dyslexia.
And it was, nobody ever told me you have dyslexia. And I didn't realize until it was over my 20s. Yeah, way over my 20s. Yeah.
So reading went really slow and that's what...
I just didn't understand stuff that will normally nowadays, I will just grab a book and get it and then go to a class and be like, oh yeah, sure. It was like trying to figure out what all these people were talking about. And I had no clue. Because I will grab a book and I will spend, multiple passes in one page, do not understand anything. Now I know I didn't read fast enough. I was taught to put letters together. Yeah. And in my life, I've been into 3 different speed reading courses. And that's how I learned to read. So it turns out my mind was going way too fast for my eyes. And that
was actually something that I recognize because I also have dyslexia and I have problems in high school reading. So maybe there is more listeners out there who had the same problems. Yeah. Don't let yourself be discouraged, listeners, because you can make it still, even though you have some challenges.
The truth is you have to read a lot if you want to be. It's just so much easier to buy a book and read 5 books and just be good at whatever you want to do. Yeah. But when you don't have the capacity or that habit, life's a challenge. Yes.
So tell us, how did the 50% challenge happen?
So let me think about it again because I haven't thought about it very well. Okay, I remember now. I've always thought about it. If you start studying investing in business, you eventually you start reading about Warren Buffett because he's such a success. He's like Bill Gates, it's like the Amazon founder, you just start reading about him. And if you start studying Buffett, then you eventually find this thing he said once in an interview, I think it was in the 90s. He said, I guarantee that I could make 50% a year if I was managing under $1 million. So you get excited because, I have under $1 million.
And he's a conservative guy, right? So he wouldn't be saying that if he didn't honestly think he could make that.
Surprising that you made that observation. Very good. Yeah. He's super conservative. So he says guarantee.
That's something that sticks to your mind, right?
That was the first time I've heard that, wow. And my mind is still running like, okay, what if I get $1 million and I learn how to do $500,000? And it will be a great lifestyle.
But I mean, before you even started this process of doing the challenge, you already had quite some years into the stock market researching, doing that. So it's not that you're new to the...
Well, I did real estate, and that's my bread and butter, if we call it that way.
That's how you make your income.
The stock market's not where I take my rent payments or I buy food from. It's just once I had the stability of real estate, I focus, everything extra goes to the stock market. But I've studied stock market for 15 years probably, or 10 years, something like that.
Mm-hmm. And when did you realize
15 years.
Something clicked for you and you were like, why not try
Very good. I was
to get this challenge?
So in last year, 2019, they have a normal meeting, the stockholders.
annual meeting of
Annual
the
meeting.
Berkshire
Thank you for
Hathaway.
helping. Yes. And they always get this question. And every year they don't know what to answer. They're like, yeah, we may have done this or we will do that. And some people even say he was misquoted, that the article's not really factually true, but that's the idea. And this last time, he just said a couple of things that piqued my interest. I will look into many things. And then he talked about real estate, and he will talk about dark stocks. And then I realized when he said that, he will do everything. Because I was looking until that moment into
different strategies,
a system. But I didn't notice that, and it's something that has happened in my mind. You need systems in your head to understand paradigms, or ways of thinking, frameworks, if that makes sense. Yeah. The problem is that you get to think that he will do it the way he started his fund, and if you see his track record, he didn't do 50% all the time. Maybe in the early years he did. When he's not fighting with partners, any papers or anything like that.
So if I see correctly, first you were thinking I need to go with a certain strategy, but the last time he said I would just look into anything and everything, and then it kind of clicked for you. So there is not one real strategy to go with. He said that
before, but when he said that, I always thought he will look into all the stocks available and he will pick certain dark, obscure, small stocks.
Yeah, because we're talking about managing smaller amounts of money, right? So,
and definitely you wanna hunt there. That's where the fish are. However,
so for the people listening, what is a dark stock?
Dark stock is basically one that's so little that it makes no sense for them to keep filing with the government. Because when you are a public stock, you file with the government some paperwork that you can see actually. That doesn't mean if they stop filing with the government, that's a bad management, a bad company.
It's just they have other things.
It's just they don't want to spend all the fortune that it takes in lawyers and to create the paperwork if they're not going to gain anything from it.
So dark stocks are basically very small companies that are public, but their capital.
And that's the irony.
Small.
Dark stocks, the idea that you don't see them, but they don't communicate well with. But that's not necessarily true. Mm-hmm. It is very true most of the time, though.
Yeah.
But they don't have to file all the paperwork and stuff like that.
Okay.
Yeah. They could be a great company. Yeah. So basically, less investors, they're afraid of them. They don't look at them. You have to call them. I was looking at one today. I have to actually call the offices so they will file me or send me the physical paper.
So sometimes you have to go after the company saying, hey, so what's going on? Can I have your yearly revenues or your yearly numbers? Exactly. And you'll get them. Maybe not always, but...
If you think about it, they have the incentive not to do it. Because if the stock is very underappreciated, they can, whenever they have a good year, they just can buy it back. So that's what I thought he would do.
Yeah, so dark stocks, real estate, other things that he was
talking
about. And
he said this time, I will look into real estate, maybe I will do that, I will look at, that's when my mindset got liberated. Like, okay, he will do everything and anything that makes sense.
Yeah.
Okay, so
it's
then
more about the timing than it is about a certain strategy.
Exactly. Well, yeah.
The strategy has to fit the timing.
So, talking about timing, let's say the market crashes. Then it's a great time to buy good companies that are undervalued, or you're gonna start seeing stocks that we talk about in this podcast that are loaded in cash and they're selling at a discount of cash. So depends what part in the cycle you are. You will look at different things, but really maybe you just see, an ice cream shop that's about to go as a franchise into 5 states. You're never going to see that in the numbers, but you're going to see it on the reports. So I saw a post of a guy that helped me. I wrote a book in Spanish, digital marketing. And this guy helped me to put it as a bestseller in Amazon, and he knew about that thing. But I saw his post that he was saying, I'll interview you. So I have actually to pay somebody to interview me. Imagine that.
So you paid him to interview you?
Of course, yeah. Because I wanted to... Everybody asked me, what do you do for a living for the last 15 years? And I always say, I invest money. And what do you invest in? Real estate. Because I don't want to say stocks, because then they think I'm a trader. Or if I say real estate, they think I'm an agent. So it creates a lot of confusion. That's what the reason I created this podcast too, is to educate people. And if they want to do the same, it's awesome. But it was mainly because most people thought they didn't know what I did.
Yeah, so you wanted to inform friends and family to give them a little bit of insight in what you're doing on a daily basis.
Kind of, yeah, teach them.
Yeah.
Because they,
Okay.
yeah,
Cool.
that could be it. So I did that. I said, I've been interviewed only twice in my life. So I was like, yeah, interview me. I want to do this challenge. And I'm going to open an account with $20,000 because I think that's the minimum I need to start doing this thing. $20,000. I put it here. This is the number of the account and it will just...
So it was public, right?
It's public. It's super public. Not only that, I put the results in a platform called GitHub, which will show you if it's altered in any way. So you'll know it's not been altered.
So kind of a track record of what you've been doing.
It's a track record. Nobody can say, no, he didn't do it. Yeah. And in the interview, he said, I'm going to do this 50%. I'm sure. And I think it's a recession coming. And it's going to be...
Not knowing it was going to be COVID-19.
I didn't know what was going to trigger it.
But yeah.
But when you have so much debt and the interest rates are almost zero, it's very little. That's normally when it goes down.
It's in the cycle.
So
yeah.
So I cannot time the 50%, but I know within 3 years, I can do that easy per year. Yeah. So how you do it? You pretty much buy 10 stocks or 3 stocks or 20 stocks that you think are going to go up 10 times. Or 5 times.
So how was that process for you? You did the interview, you said, I'm going to do it. You opened the account, you put X amount of money in it. Mm-hmm. And then what did you do then? Because how did you pick the stocks?
So I've been reading a lot in my free time. This is my hobby that I turn into a full-time event.
So from hating reading in school, you're now reading is your hobby.
Yeah, I read around couple hundred pages a day.
That's crazy.
When I can that's the key, when I can focus. So life throws you a lot of problems. The key is to being able to create such a simple life that you don't have any of those problems. I used to have a company and I had like 15 people working for me in digital marketing, and there's no way I could have done it there. The only reason...
need the time and space in your mind
to
be able to concentrate.
And in 2019, the middle of 2018, all the projects or perspectives that I had were over. Like, finished the development of the house that I'm in. I just finished a little bit of construction, and I decided not to go for any more crazy ideas. Just start doing this thing. And I do want to help my friends and family, right? Because it happened to me in 2008. The market crashed. I go to the US and I start buying houses incredibly cheap. And I knew they were going to go up 3, 4, 5 times in 5 years. And I start going around to everybody like, hey, I can do this. Look at the numbers, go to the data. And they're all looking at the data and being afraid and being like, yeah, but we don't have money now to invest. So I wouldn't bother them. I knew I was right. I knew this was a one in a lifetime opportunity, but I didn't push hard enough. And years later, I bought like 4 or 5 houses and they went up 300%. And I had rental every month. So it was like, yeah, that's it. Yeah. Game over, won the game. But as the years passed, I realized that's great for me, but how does anybody else benefit from it? I could have pushed more people to try to invest with me and help them too.
Lift them up as well.
Yes.
Into more prosperity.
Yeah.
Say that?
I mean, I'm not a psychologist. I don't know how to find them happiness, but I know how to make some money, and I can help you with that for sure.
So how does that reflect onto
today?
Yeah.
I saw it again. And that's the reason, answering your question why I did this. I just wanted to prove from my families that I know what I'm talking about. Of course, I'm not raising money through this podcast, by the way. I'm not a regulated... Disclaimer. I do not manage money from other people. But I can manage legally money from friends and family. Yeah. Up to, yeah.
So with this challenge, you wanted to show your friends and family, like, hey, I am into this and I know what I'm doing.
Yeah.
And then...
Here's a track record.
So I actually want to go a little bit more into the process of trading the stocks.
Okay, are we getting...
During the challenge.
So like we can get technical now.
You can get a little bit technical, but I do want to let people know what your process through this challenge was, because it was not always only ups, it's a fluctuating process as well. So I want to take people a little bit through the process that you went through. Can you tell us a little about how that went?
Okay, so... First of all, I think we should discuss it's not a good idea to do this challenge.
Oh my God.
Let me think about it for a second. Why not is a good idea? Because it takes 20 years to create a reputation and 5 minutes to destroy it.
Yeah.
I did it because I have a high level of certainty that if something happened, I could do this. If something else happened, I could do that within a reasonable period, right? But if you think about it, I put my reputation on the line, and anybody that should do this is with if you're gonna go and get interviewed for by one person, because it's easy to create multiple accounts of interview by 100 people, and eventually you get an account that gets 50%, and you come out with that interview and say, hey,
maybe other accounts.
Yeah, no, this is one account, one interview, real money, but what do you gain? And one thing I didn't think about is low expectations. The key to get a long-lasting marriage, the one quality you need in a long-lasting marriage is low expectation. And when you get in business with somebody, you're getting into kind of a financial marriage. So when people started seeing that 50%, the friends that actually told me, I started telling people, hey, maybe I can help you now in the COVID-19, you're losing your business, all of that, I know I can help you, or at least diversify what you're doing.
Yeah.
And they were like, yeah, okay, but how much can you make me in 3 months? They're afraid to invest. And, but yeah.
Because investing is, what you always tell is that you have to forget you have that money. It needs to be some money that you're able to lose, because it's never a certainty you're going to make money. I mean, it's still based on predictions that you make, but they might not be the truth in the end. So you can invest that money, but you might lose everything.
Yeah, oh yeah,
or you're making money, but it could go either way. Yeah.
In my mind, it's so much better if I could buy a house or home for myself and a car, or have a portfolio of stocks. I would rather have a portfolio of stocks. That's how certain I am about this, because I know what I'm investing in. And if you have 10 things that are not really correlated, one can become a fraud, or maybe this one, exploded or something. And
that's all about the diversification of your portfolio.
One is going to go up 3 times. The other one is going to go to 0. You're still up. Yeah. Does that make sense?
It needs to balance out.
Yeah.
All the positions needs to balance out.
Yeah, and I have a pretty concentrated portfolio for this purpose. If I was going to just take off for 20 years, I would make a super diversified.
So what do you look at when you go for a stock or a position? What do you look for? We've talked a little bit about the dark stocks. That's something you're doing.
Okay.
People who maybe heard the podcast have nets. Can you tell us a little bit more?
So you want to do things to understand. Does that make sense? And the Charlie Munger sage says, 1, you need to understand it. You need a good business. That's what he means by understanding. 2, you need good management. 3, you need that business to be protected by competitive advantages. He called it a moat. Moat is this little river that goes around the castle that stops everybody from attacking it. Yeah. So he thinks about business like a castle. And the 4th one is price. Because you can have a great business if you don't pay the right price. It's a bad investment.
Yeah, because how you tell it is that you rather buy stuff that's on sale, because you're buying something that's actually worth more, but you're buying it at a discount. That's for the people who don't have a lot of background in this finance or stocks. That's the way to think about it, because you buy it on a sale, you can resell it, but then for the normal price. Yeah, that's the idea.
Just to get it, we're supposed to go technically later, right? But let me give you a couple of ideas so it clarifies. Let me give you 2 ideas that pop to mind. I just interviewed somebody in this podcast. He was talking about Oroco. He clearly found this mine that's in Mexico, right? Owned by a Canadian company that's so tiny that nobody's looking at it except him. And he found it in a very strange way. He was investing in another company and saw that the CEO was buying stocks in this other little company that was worth $2 million or something, like nothing for the stock market, right? Yeah. And he started looking into it, calling the office, what is this? Why? Amazing smart guy. Researcher. Oh my God. That's what it takes. And he starts reading through the cases and the legal cases, and finds that this mine has been in lawsuits for 20 years, and they just came out or are about to come out of these lawsuits. And they actually have done the studies 20 years before, historical studies, perforations, that's what it's called. So that's amazing. Nobody's looking at it. There's something to be mined there. They just need to update it. Now they're currently updating that to new standards of security for drilling, because the stock should be worth $200 million to $1 billion, and right now it's trading at $50 million. Other idea is VTU. It's a conglomerate of cars, England. It was a high recurring income from repairing cars. I'm not that sure in England right now, the numbers I forget. But VTU has a lot of these places that sell cars, and is trading at less of their book value, which means that if they die today and pay all the debt and they sell all the assets, you will double your...
Then there will be money left. There will be money left to stockholders.
Yeah, you will pretty much double it. Yeah. And
so they're completely different businesses.
And so they're making
depending
money.
On what you find.
And they're making money very predictably. Very predictably. So it's like buying a piece of real estate, an apartment, a house, and renting it. it gets complex with stocks because there's so many moving parts. But eventually, the way of thinking about stocks is that you can buy a property, fix it, and sell it again, or let the management fix it, sell it again, or you can rent and hold.
Yeah.
That's a way for depreciation to go up, or just get the rent every month.
So let me ask you, what do you think of, people buying an index fund? Or shall we go into that later?
If no, it's a good time. You made a question. An index fund depends what you mean by. Normally, people buy the Standard & Poor's 500 stocks, or the Dow. It's 50 industrial stocks. There's Nasdaq is just mostly technology stocks. Amazon. But let's refer to the Standard & Poor's because it's the 500 most, the biggest, most popular stocks. If you buy that, you're probably going to beat everybody in the long term, and I'm talking about 30, 40 years. If you do that, it's actually a good idea because you're going to beat 75% of professional money managers out there. And all you have to do is put you take your paycheck or your rental income, whatever you're doing, and put as much as you can every month. And the market's going to go down 50%, it's going to go out 120%, and many years it's not going to do nothing,
And because there's like a lot of companies inside this fund can be that maybe one company's going to go broke and will disappear, but all the other ones will still exist. So the range of movement from the fund might not be that high skyrocketing or sky down.
You're very smart. I'm very impressed. What you just described is called a trend following system.
Yeah.
And that's exactly why it's so hard to beat the Standard & Poor's, because it's a trending system. And the whole paradigm of in trading stocks, which is one of the episodes we did with Van Tharp, which was my mentor in trading many years ago. It's one of the golden rules of trading is let your winners run and cut your losers. Kind of makes sense. Like if you buy 20 stocks and 2 or 3 start 100%, 200%, start doubling, triplicating. You don't cut those positions. You don't make them smaller necessarily. Some institutions do that because, they want to minimize their fluctuations. But if you buy an Amazon when it's starting out, the last thing you want to do is sell those stocks. It's going to go from $5 to $2,000. Yeah. You want to concentrate in those. So, answering your question.
So these funds are actually parting into the ones that you don't want, the ones that, go broke, they disappear. But only the good ones will stay in.
They get delisted from the Standard & Poor's or the Nasdaq. So
it could be an interesting way for people who might not have all the time in the world to read all day to go invest in an investment fund.
Just make sure that you invest in a because there's different funds. You don't really go and buy the 500 stocks yourself. You buy
a fraction of it.
You buy a fund, an ETF.
Exactly.
An ETF, which they go and they buy the 500 and manage them for you. So you let a
company
the ticker symbol is VOO. It's a Vanguard. So but there's no differentiation. Everybody can do that. So you want the low cost provider, the one that's not gonna charge you as many fees as possible.
Exactly.
So Vanguard's the best one.
Yeah.
Mm-hmm. And plus, you have to have something and keep something in mind. It could be a long time from high to high. Let's say right now, we could have seen a high in the
like beginning this year. We high and then it went down.
COVID came down. Yeah. I think it's gonna pass this high sooner than later because there's so much money being printed and the markets are being manipulated by the government, so they go and buy the bonds and the stocks themselves.
We've already been seeing that a little bit in the stock market, right? That in general, the stocks haven't been dumping as much anymore. They're either stagnating or going up again.
So now that we're touching on that subject, the way I made that money rather sooner than later because I was expecting it to take 3 years.
You mean the money in the
50% return is because I changed strategy right away when the market crashed. So I had like a 2-week window to take a decision. Do you stay out of the stocks or do you double down in
because what happened? Because you already had stocks.
I was a lot in cash. I was in a lot of cash. I don't mind waiting for a long period of time. Yeah. So I had, 10, 20% of my 80, 60% was in cash.
Okay, so you still had that cash, and when market dropped, you saw all these companies that you already knew because you already done all the research before that were good, but they were too highly priced at that point. So now that the market was crashing, you knew, they're like in a major discount right now. I'm gonna buy them.
Okay.
Am I saying it right, or is that
almost nail it? Yes. So the things crashes 1 day, 2 days, 3 days. I don't look at the stock market maybe once a week, and I started reading the news. I do read the news every day. I don't know how good is that, but yeah, at that moment I'm glad I was doing that. And I start seeing this. Fall X. The X% the stock market is crashing. And I go like 3 days into reading this news, like the biggest drop in I don't know how long. I start looking at the chart, and I know statistically if you look at the crashes of history, they normally hit 30-40%, and they take and when they recoup fast, like it's happening right now, they normally continue to do so by 3 years.
which they usually call a V-shape?
But could be. But statistically talking, is not necessarily that's going to happen again. So you still have to think about a lot of things. What made me take the decision is that the Fed came out, the federal,
Reserve of the United States.
the central bank in the U.S.
And later also the European.
And later Europe.
Yeah.
And I was waiting for that news because that's what happened the last time. And we learned our lessons from 10 years ago. Because if you remember 10 years ago, if you were paying attention to the stock market, it took a while. Congress went into, it was a political problem and all of that. And the chair of the Federal Reserve had to pass through a lot of problems to get those checks signed. And this time, the guy from the central bank came out and said, we're going to print as much money as we possibly need. So basically gave a white check to the central government. Like, here you go. And that's...
What happens with that money?
They distributed the best they can to stop the crash. And I knew that moment there's something called the Cantillon. He was French. No, he was Irish, but his last name is French. Cantillon is one of the first economists, modern economists, maybe the first modern economist of this era. And he said clearly, when you print money, the people that receive it first have the most gains. So who receives these checks? Is it you, me? Is the people on the street? No, it's the big companies, the big corporations that are trading in the Standard & Poor's. So what I did is I put a big amount of the account into a leverage ETF, in 2 leverage ETFs, just in case, because I was very...
What does that mean, leverage ETF?
Leverage ETF is that they do dark magic to whenever Standard & Poor's goes up 1 point, they go up 3 points, in theory.
Go down?
And they go down 3 points.
Yeah, so it's more risky.
It's super.
You need to know what you're doing.
You have to have, yeah.
How do you cope with packaging that risk? Are there any things you can do to manage that risk?
Depends what you mean by risk. Yes, there is, but there's 2 definitions of risk. And the normal definition that they teach in college is that volatility is risky. I don't see volatility as risky. I like volatility a lot because then you can buy low and sell high.
Yeah.
What I define as risk is not knowing what you're doing. Guessing.
Yeah.
Yeah. So most of the time I was going crazy. Those, like, for 2-3 months I was not sleeping well. I was just not because I was worried, but because I was learning so much. I jump into these ETFs. Okay, who runs the ETF? They have a lot of credit default swaps, which are complicated financial instruments. So you have to go and look, okay, who are they buying from? Okay, the Swiss bank right here. Let's take a look into the Swiss bank. So it's a lot of work just to sleep right at night. And then you have to also, that was the major position. As you can see, you could probably walk into my blog, look at the blog post, and you'll be guided to the data, what we bought, when we bought it. Yeah, that was basically the main position. And so it went down like 30-40% at some point. And I was okay with that. I was just super happy to have had the position because the Federal Reserve came out and said, hey.
So at some point you knew it was most likely going to go up.
You don't want to fight the Fed. Yeah. That's why I learned in 2008. Because it's...
What do you mean by that?
They print the money. So if they print the money, you
better go buckle up and go with the ride, or...
Yeah. It's... Very few people know how money really works. If you really want to learn that, you should look at Mike Maloney's videos.
Yeah, they're very...
You've seen them, yeah.
Clear. They're very... for anybody listening, I can really advise it. I didn't have a financial background. It gives you a clear idea. And don't watch it once, but watch it a couple of times, because then stuff is going to click and you're going to understand better.
And basically what it says is the rich make the rules. And if you make the rules, you make the money. And so let's talk a little bit about that. When the Fed prints money, they're actually charging you a tax, and it's an invisible tax because now there's more money into existence, and the money you have in your pocket or your bank account and now is worth less. And
how does that work? It's
called inflation, and you have to invest. Like if you're sitting down in cash in 10 years, you're going to be able to buy way, way less.
Yeah, so the buying force will decrease over time.
Buying power, yeah. Exactly. So that's why we invest, and that's why it's so important for us to learn how to invest and save, but don't put it in a bank account at 0.25% a year, please.
Or 0%.
Do something smart. Do something smart.
Yeah. So to go back to those stocks. So
yeah,
and you had something that was very risky, a position. So
risky? I won't say risky.
Okay,
volatile.
Volatile.
Yeah.
Wrong word. Sorry.
Wrong word. Yeah. If you sell me Coca-Cola for $1, I'm gonna like it way more if you sell me Coca-Cola stock for 50. Just give me the stock.
Yeah. So I noticed that you put kind of counter orders in to manage your risks, or maybe I shouldn't say risk, but you manage
it could be
like options, and you put in
okay, let me see,
counter options and stop orders, and you know all those kind of things. Maybe for some people it's obvious, and they've been into the stock market for a longer time, but it would be interesting for the people who are starting out to learn a little bit more about that, because that's actually how you should invest more. Okay. I think that's a big part of it as well. So I think they should know. A
little crash course then. Investing and speculating or trading, it's pretty much the same mechanically. You go and buy stock. If it goes to where you think it's going to go or past that, you sell it. If it goes against you, then you have the choice to not do nothing or sell it to not stop losing it. Stop losing money. The one thing you can control is how much of something you buy and when you buy it and when you sell it. That how much is the key of everything. It's called position sizing. And Buffett created the term. It's everybody in the industry knows. And in our interview, we're talking about that because I know he kicks himself down because he didn't patent that.
Oh, really?
He could have patented the term, but he created it. And he was like, I didn't trademark it. Sorry, trademark is different. Yeah. So he was like, I should have trademarked it. I would have made a fortune. Exactly.
That's always talking in the end about.
Yeah, hindsight 2020, right? But he created a term, and it's very simple. It's if you don't know what you're doing, you really want to buy 1%, 2%. Maybe 3% of your portfolio goes to that gambling of some kind.
Because that goes back to that for things that Charlie Munger said, right? You have to understand it. It has to have a good management. Needs
a competitive advantage. Has to have a moat.
Price needs to be good.
Yeah.
So if you don't know if you don't know all of those four, you're kind of dealing with a company you kind of speculate on.
You're speculating, and it's okay to speculate if you do it smart. If you have a plan before you jump in.
Exactly. And
your position sizing is right. Actually, there's a lot of people that make a lot of money that way, but I've never seen a trader being the Forbes most 500 richest people in the world. I've never seen that. Mm-hmm. So that's why I don't think it really works in the long term.
Okay.
It's one step forward, two back. Yeah. So that's why I don't really. But there's a space to do trading. Yeah, I think speculating. I'm sorry. Warren Buffett used to call it in a certain way. Most people think he never speculated. That's not really true. He called it workouts. There's a lot of speculation in the workouts. It's things could go wrong, and the earnings are so little you have to leverage.
Well, so you only buy a small portion of your portfolio in these uncertain things.
Yeah. So if you see what you buy so let's say you're following one of these gurus on what they're buying, right? The first thing I do is to see how much of their portfolio it is, because if they're buying 1,000, there's a lot of gurus that buy hundreds of stocks based on mathematical formulas and whatever. So you want to see how many stocks do they have. If they have over 100 stocks, that means they're probably buying 1% or less of their position. They're just and they're not necessarily gambling, but they're using mathematical formulas that probably they don't even know what they're buying. Right? And they still make money. But when you focus, you sleep better, And that's the important part. And you compound. Yeah, if the stock I just gave you 2 stocks that can go up 100% tomorrow. Well, to make 100% of an investment is hard. Think about it. You buy a house and then you have 2. Super hard. But there's 2 ideas. Now, could somebody come tomorrow and say, well, yes, you know that BTU or whatever I just said a moment ago, it's a fraud. Yeah, that could happen. It's rare, but it could happen. Or they get into some scandal somehow. That's why you need 10 of these positions.
So depending on
give or take
how much you know about stock, size your position size on the specific stock.
Yeah.
So what?
And you have to also take into account the risk reward ratio. One thing is to buy today Berkshire Hathaway. It's $100 today. Yeah. And it's worth at least $220 if you know how to value the stock. It's at least $220 today. And but that's 15% upside, 20% or something in between. Yeah. So it's a certain money. But is it exciting? If you pull your whole position into it, I will sleep like a baby, you know, and I'll make 20% in 1 to 3 years. Yeah. But that's not exciting. I have better ideas. Now, Oracle.
So you want it to be a little bit exciting too.
No. I did say something. I shouldn't say that. You should get your excitement from something else. That's like your investments. But it's not interesting enough. Okay, I have better ideas.
There's not much happening.
Yeah, I have better ideas.
Yeah. Okay. It could make you more.
Oracle could go up. Yeah. Now it's double since we covered that thing in the podcast, but it could go up 5 times.
But so to go back to my initial question is like you put counter positions, right? So
what is a counter position? What do you mean by that?
Well, maybe the term is wrong, but like I know that you can put when you buy something, you have a certain amount of stocks, and you can already put an order in, like if it's hitting the amount of money you want for it, like you have
I take
thought
profit
about that it will automatically sell.
Perfect.
Or a limit order.
That comes from a trading mindset. That's more a trader kind of. Value investors or big investors don't do that. I don't think so. At least they're trying not to do that because. If Coca-Cola is fine, let's say Amazon after the stock, the bubble of the 1999, it started going down. I think it hit $5, $6. My memory is not that good. But their metrics were going up every year. Every month, the CEO came out and said, the stock keep going down and our metrics of the company was becoming better. And, but there was no correlation between the price and the quality of the business. So would you use a stop there? Probably not. But in other situations, like, let me think about an idea that could be worth it. Like, okay, a company is going to be acquired by another one, right? So this company is trading at fair value, say $100 per stock. And when it closes, it's going to be worth $105. But then you do want to have a stop just in case it goes to 90 or something like that, because then something in your thesis is not right. You want to jump out faster.
So that's why you put them in. That if it's going differently than you had anticipated, then at least you can put something into.
Okay, so for example, I think I know where you get this from. If you see the report, we got some positions leveraged ETFs. So every time there was a point going up in the Standard & Poor's, we were getting 3 points up.
Yeah.
Okay, so that was...
But I'm not talking about that because there's leveraged ETFs. Of course, they're volatile, so you cannot put those stops.
But that's the kind of thing. It's like a hot potato. I knew I didn't want to stay with them more than a couple of months, so I was using stops in those. And the higher they go, the tighter my stop will go. So when they went actually down, I sold them. Yeah, lost a little bit of money, but I made like.
Yeah. Okay, cool. So I actually want to talk about options.
Cool.
Is that something to talk about?
Sure.
What do you know about options?
I actually have an account.
So tell our listeners what is an option.
Option is a contract where you promise to buy something. In this case, a stock.
In the future.
In the future, and you get paid for that in advance.
So you sell the contract now to buy something in the future, but you're getting money right now.
Think about insurance. What do?
You pay your monthly, yearly.
Before you die or before you get in crash, right? Exactly the same as options.
Okay.
Yeah, that's it. An option is an insurance policy that you sell or buy.
So what is so interesting about it? Or what could be interesting?
There's a couple of things you can leverage. Is like if you buy an option, it's like buying 100 stocks. Does that make sense? You control 100 stocks basically with one option.
So they're never in one specific.
It varies depending on the instrument. However, let's say you right now buy one contract of Amazon. That contract gives you the right to buy or sell in the future 100 stocks of Amazon. So you have a lot of leverage and you don't really have to pay but 5% or something like that. The price varies with volatility because options are priced very efficiently, actually, most of the time. The way to make money on options is when you buy an option before the volatility explodes. Does that make sense?
Why is that?
Because there's basically, I think, 3 variables on the pricing of options. It's called, I can't even pronounce the name of the guy that made the model to price them. I'm not even going to try.
We'll put it somewhere underneath.
It's super famous. Schwartz, Black and Scholes model or formula. That's what it's called. So these guys got the Nobel Prize on economy because of this formula, and basically says the way to price an option, you need the price, you need the future price of something, and you need implied volatility, which is the volatility, the risk. They call it risk. But the problem with that is that it's a great tool for a know-nothing investor. Meaning, you're trading. If you have 100 of those little things going around, that's perfect. That's great. If you know nothing, you have 5 minutes to trade a day, or have an hour here, have an hour there, while you're having coffee.
So it's a good option for people who don't have a lot of time to spend on the stock market.
Exactly, and you want to sell options because normally they're overpriced. Okay, so if I sell insurance, I don't want to lose money. I'm gonna sell you with a little premium. I'm gonna make some money.
Oh, okay.
And you and I have the same data, historical data. The problem is that everybody has access to the same data. Historical data is not the same as the future, right? Like if you were looking at something that's about to explode now. Oracle, let's go back to that mine. If you look at the historic data, you wouldn't have a clue what's going on. Not a clue.
Because nothing has been going on
for
a long time.
ages. For 10 years, that thing has been losing money.
So if you use that in your calculation...
And you're selling options, you're dead.
Then, of course, the option is going to be very low because you're not expecting it to go up.
Exactly.
But
you have no historical data to show that it's going to explode. Okay. So that's when you want to buy options.
Yeah.
If not, if you're doing Microsoft or you're doing a giant like that where everybody's looking at the financial statements and there's the most smart people in the world are looking at it, then you rather sell options because you're gonna probably make money long term with that.
Okay, cool.
Yeah.
Nice.
Good. Great questions.
Thank you.
Is any
No, I think maybe we can go into a couple of stocks, a little technical.
Let me see. What would you like?
What do you have?
For the challenge?
For the challenge, let's pick some from the challenge.
Then everybody can see this in they go to the my blog.
Yeah, and they can browse
they can see the portfolio
the blog as well. Yeah.
Let me see because I actually opened it here to check it out. So we bought these ETFs, leveraged ETFs. They were of almost 50% of the count. But the problem I was having with these ETFs is the moment the volatility goes up, and believe me, we saw so much volatility when the market started crashing that the options were overpriced. We just talked about that, so now we can talk about it. So
for the person who was selling the options, it was a good idea.
Whoever was going to sell me insurance was going to charge me a lot of money for it.
Yeah, because it was so volatile.
Yes.
They made the premium, so the extra money you have to pay high.
When it crashed, I had a position a little too early, but because I don't know the future. Yeah. So I just had to decide at one point, I'm just going to buy now and just hold. Yeah. If it started going down to whatever, I'll just hold it.
And buy more.
Mm-hmm. Yeah. The problem is that there's a risk that these ETFs crash if it goes down too much. And I was a little iffy. So what I did is replace them slowly but surely with options. Right, so instead of having a 25% position, I bought 5% of my portfolio in a long-term contract, an option called a leap. And yes, I overpay a little bit, but for every dollar that goes over my break even, I make.
So you calculate the amount that will be break even that you invested as much as you got back, and then anything that goes above it, then you're happy because then you're making money.
So if the Standard & Poor's was gonna go back to former heights, a V-shaped recovery, I was gonna make almost 100% of my money.
Wow.
Yep, that was the thesis on it. And if I could just buy options, I would risk very little of my capital if it goes to zero. 10% of my portfolio risk. Yeah.
Okay,
So
cool.
that was the idea. What else did we do? A couple hours. LFE is a Canadian life insurance company. Thought life insurance was being unfairly mispriced because, there was this risk that coronavirus was going to kill everybody and they're gonna get the life insurance.
Yeah, we didn't know then what
So-
the results would be of the COVID.
LFE is a Canadian fund that has multiple funds. But that was a mistake because I started looking into it more closely, and it went up, but it wasn't like the greatest idea ever.
It wasn't as much as you initially expected.
I
it
could
to.
have done 20 better things. And if I was really smart, I would have bought something like NASDAQ. That went up over 100%. Now I think about it, it's like, duh, obviously, internet companies, they not get hit as much as normal companies.
Yeah, everybody's gonna buy everything online. Yeah.
Yeah, what an idiot. But yeah.
Yeah.
There we go. Yeah. Berkshire, I bought that thing when it hit, I don't remember that. 170, we saw it when it hit 200. So we made some money there. Freddie Mac and Fannie Mae were two major banks that we had before. Because Trump was coming out and saying, they were the poster child of the 2008 problem, where mortgages were just a problem and these banks take the biggest hit and the government has to come out and rescue them.
Yeah.
But the problem is that the politicians, fairly, I think, they said, you have to pay us back, and they did. The problem is that when they did, the politicians said, well, just keep giving us the money because we saved you, instead of giving it back to shareholders, which is pretty bad. So Trump came out probably 3-4 months before the coronavirus problem even started, and he was looking into giving back, privatizing again Freddie Mac and Fannie Mae. Then we'll have had a 10 bagger, or it will have gone 10 times out. So, but that never happened. Now we're probably gonna get some Democrats going back into as presidents, and so that was a bad idea. But it was only like 3% of our positions. They were actually some gambles.
So you sized your position.
Exactly. So we were diversified because basically we were leveraging the Standard & Poor's, and these ETFs have some. The problem with ETFs is everything I read about these leverage ETFs were like, they're super dangerous, don't touch them. They're super dangerous, don't touch them. But nobody will say why. Mm-hmm. And as I researched it more and more, I found, well, it's not really that way. Everybody's wrong. It could be a hot potato because, you don't really know what the contracts say in this very complex financial instruments. But at the end of the day...
Yeah, so you really have to find out for yourself how risky or dangerous you find these leveraged...
Every ETF were 800 pages.
Yeah. So
now... And my first language is Spanish. So now you can know why I was like... I couldn't really sleep for weeks or months. Is because I had so much work in front of me. Yeah. And I had to do it fast because time was... Yeah,
time is of the essence.
Yeah.
Especially when something like this is going on, you don't know what is going to be said the next day by the political parties.
And your leverage, right?
So. Your leverage, every day is going to be different depending on what statements are going to be out there, what is going to happen with the company. So, you need to take action, big action.
Yeah, and stick to your guns. And when you take a decision, you base it on some facts that you're looking for. Yeah. And those 800 pages, there was like a couple of paragraphs where it said, if volatility is high, our results are going to suck, probably. And I was like, damn, okay. And then I had to take a decision on that.
Yeah.
That's why I didn't want to hold them for too long. Or else I would just hold those for a while.
Knowing that probably the market is going to go up again. And then even though it's going to go down in the middle points, it will go up in the end.
But the thing about, credit is, swaps, default swaps, credit default swaps. Are priced probably the same way options are. So when volatility is high, the price you're paying for those credit default swaps are too high, making it a bad investment. Yeah. So that was the thought I had behind these ETFs, that I had to research a lot before having those positions. That makes sense. But you made the right questions, now you understand it. Very good.
Thank you.
Very good.
For the listeners, I'm quite new to the topic, so a little bit of my background. And
we have an interview with you in the podcast.
Yeah, we do.
You started in real estate.
Yeah.
So what do you think now, by the way,
about
real estate versus stocks?
For me, real estate makes more sense because I understand it better. I have a better notion that it's something that I have always really liked, so it makes more sense for me. And I'm not a big fan of reading. I'm not like the financial stuff. It's still there to click in my mind, and I'm getting there, but I'm for sure not as far as I need to be to stock market, but also I don't have the time currently to put all the energy in there to make that step. So if I wanted to, I think I could, but...
So closing this topic, probably with 50%, it can be done. I think we just covered a lot of ground on that. We just proved we can do it.
Yeah.
I don't know what else to say.
No, I don't have...
It's a lot of work. And it's... I've been doing this for probably 10 years on the side, and putting a lot of focus on it.
Exactly.
So that's the price to pay. If you think you can do it 50%, just like... Remember, I changed my strategy in like a couple of days, right? I was gonna go for this... I was buying Lumber Liquidators, which is a flooring company in the United States. I actually went to the US to check them out and all of that, and actually had to change my strategy completely.
Yeah, because of the situations that were happening in the global economy. Yeah.
So the key here is to adapt. You have to do what makes sense, and that you can only get that or there when you have a lot of tool belt. Net, start stocks, big stocks, banks, insurance companies.
Exactly. And those account for different strategies. So when something is not working, you have to be able to switch to something else.
Years of learning. That's where it comes from.
Cool.
Thank you very much.
Thank you. Is there something else you want to tell the people who are listening? What's your message for them?
Well, this is a financially free podcast, so we're going to talk about financial freedom. The reason we've been talking about so many subjects is because you need to do real estate, you need to do stocks, you need to do everything in between. But the real key here is to learn and learn what fast.
Fits for you.
And it's amazing how fast you can learn when you really want to. For example, I thought it was really hard to read a book a week, and then I read somewhere that people read 1,000 pages a day as normal stuff. Time to raise the level.
Yeah.
And sometimes now I guess I read a couple hundred pages nowadays. But
Thank you.
Raise your level. Thank you.
Okay. Thank you for listening, and
see you in the next occasion.
Thanks.
Did you learn something today? How can you apply your insights? What's next for you? The fastest way to make things happen is to just share this podcast episode with more people that may find it valuable too. Talk about it with them and surround yourself with like-minded people. Hope you found this valuable. Don't forget to subscribe. See you next time.
This podcast references opinions and is for information purposes only, not intended to be investment advice. Seek a duly licensed professional for investment advice.